When I hop into my M1 Finance growth and dividend growth portfolio, I see all types of different companies. I see fast growing companies. I see small cap risky companies. I see very old school defensive dividend growth stories. I see all different types of businesses and all different types of industries. And in today's video, I want to highlight 5 companies that I think are the most offensive, most predictable, and most diversified companies that you can invest in. And these companies are ones that are not going to be your high flying growth names. For example, hopping over to my portfolio tracker here, you can see my holding weighting in my growth portfolio has some very high growth risky companies like a Crocs. This is a company that is very risky that could not turn out well very easily. That said, we have companies in here that are extremely defensive. Companies in here that will return capital to shareholders no matter what the economic environment looks like, despite whether or not we're in a bull market, a bear market, a recession, a booming economy. These companies are defensive, are going to do great over the next several years. And so these are the companies that I picked out for my top 5, and I'm going to go over these 5 right now. It's Procter Gamble, it's Microsoft, it's PepsiCo, it's JPMorgan Chase, and Berkshire Hathaway. And I wanted to highlight some just key insights and quick pieces of data if you're looking for 5 guaranteed companies. Now, no returns in the stock market are guaranteed, but this is the closest to guaranteed in my opinion that you can get. If you invest in these companies for 10 years, the likelihood of you making money is as close to a sure thing as you can possibly get. Do your own research, do your own due diligence. Do not buy these stocks on a whim without doing your own research into them, but these are companies that I think are going to do just fine. So without further ado, let's go ahead and dive into it. My name is Jordan. I'm a millennial investor. This is my portfolio balance at the first of the month every month since starting YouTube with my original $1,500 investment in April of 2020 and my portfolio holdings in my growth portfolio right here. My current balance as of the time of this filming is $37,569, and then here's my performance since joining this brokerage. And these portfolios that we're going to be going over and highlighting and the brokerage you see right now, which is M1 Finance, is showed down below in the description, and you can get $10 for getting signed up, which you can see right here. 127 people have done so far. So get $10, help support the channel, and without further ado, let's go ahead and get started with the first one, which is Procter Gamble. Now, this is one of the most defensive companies in the entire stock market. It's hard to find a company that is more of a surefire way to just generate revenue than good old-fashioned Procter Gamble. You can see at this company's chart going back to 1986 has steadily grown its revenue from $15.44 billion up to today's most recent reporting of $80.19 billion. It's had a 5-year compounded growth rate of 4% and generally grows at around 5% year over year over the long term. Now, the profitability has the same story, going up over time, and it pays a steady dividend yield and slowly buys back its own shares over time despite this big uproar here in 2006. It generally buys back its own shares and then of course raises that dividend like it has for decades and decades and decades on end, continually going higher and higher every single year. Now, Procter & Gamble has a diversity of products, and you might notice most of these by name. Let's go ahead and zoom in a little bit so you can get a closer look here. Whether it's Bounty paper towels or Love's or Charmin or Tide or Downy or Cascade or Iams Dog's Treats or Tide Pods, it doesn't matter what you're looking at. Many of these products you probably all know and love and probably use on a daily basis. Now, Procter & Gamble has not only maintained a lot of these brands, but is often acquiring new ones as well. So that is what has led to this company getting higher revenues, getting higher profits, and utilizing its cash in a way that is beneficial to shareholders and the company itself. It uses its free cash flow, this number that you see right here, and rather than just keeping that on the balance sheet, it pays dividends, it buys back shares, and then of course buys back other companies that it finds attractive to add of its suite of products. So this portfolio of brands is not over, and I think that this will continue to sell through all these diversified categories throughout the next decade. Now, next we have Microsoft. If you look at Microsoft, it's one of the most highly valued companies in the entire stock market. At a $1.71 trillion market cap, Microsoft sits at the second largest company on earth with a 10-year compounded growth rate at 10% and a 5-year compounded growth rate at 17%. This company has reached sky-high level of scale and size and just overall dominance in our world and the stock market. $200 billion in revenue last year. It's expected to breach that this year because the quarterly results is already back to all-time highs with the most recent high of $51.87 billion in revenue. This chart just basically goes vertical and to the right. Now, not only that, but the profitability tends to do the same thing as well over time, especially since they shifted to a more subscription-based model. They have become more and more profitable, generally generating tens of billions of dollars of free cash flow every single quarter, and on an annual basis, generating $65 billion last year, and that's expected to grow this year. Like Procter Gamble, this company raised its dividend, it buys back shares, and overall the company's moving in a forward positive direction. Something else I might add that Microsoft have that many of these other larger companies don't, it is a superior balance sheet. Most recently on their cash on hand, they had $105 billion versus their long-term debt sitting at only $47. So they have net cash of about $50 billion. They could pay off all their debt tomorrow and still have $50 billion plus on the balance sheet, and it's getting healthier by the day, and this cash pile really comes in handy when you have a nasty recession going through. And that's really what happened in 2008 when this was really low at around $20 billion. They've been raising that cash pile ever since. Now, this is a suite of products. It's a suite of software that you can subscribe to that many other businesses just consider a staple. And it has many other growth categories as well, like search engines, like video conferencing, Xbox gaming. There's many other categories that Microsoft is growing into, but you get the point. Long story short, Microsoft is a growing beast, and it's one of the highly most dependent subscription-based revenue companies you can find in the market, and it's so dependent. It doesn't matter what happens with the economy, people are still going to need Microsoft Office and its suite of products. It doesn't matter what happens with the economy, people are still going to need to use search engines. People are still going to need Microsoft Azure, web infrastructure. People are still going to use Xbox gaming, and that is what makes this one an easy buy. Now, next up, we have Pepsi, and this is one of my favorite, not only because I love this company as an investment, but I love it as a consumer. Many of their products I just absolutely love and use every single day, including my most favorite, Mountain Dew. Now, Mountain Dew, I've talked about on the channel before, I'm a huge fan of, but it's not just Mountain Dew. I love mug root beer. I literally drink it every single day at lunch at Paycom every single day. I love Cheetos. I love Doritos. I love Lay's, Tostitos. I love Taco Bell and KFC and all these different brands that they have either started, bought out, or been a part of to help grow it to the massive company that it is today. PepsiCo is one of the most reliant. And Pepsi is one that I don't need to spend a lot of time on. I don't need to subscribe it very well. And this company just had a 4% green day on, guess what? A raised guidance. Because this company, despite the recession, is saying, hey, no matter what's happening with the economy, people still have to eat, people still have to drink. And so it's easy to hop over to the research tab here and type in ticker symbol PEP for Pepsi and look year to date that this company's down 6%. But essentially, no matter where the stock goes, up, down, in the middle, or spinning in a circle, at the end of the day, people have to eat. People have to drink. Whether you like snacks, whether you like beverages, they got you. Any food or drink related product, it's very likely that you like at least one, if not multiple, of Pepsi's products, and that's not going away anytime soon. Now, next up you see a long-term interest rate chart. And this is not a company, but this is a long-term chart of historical interest rates. Now, there's something I want to point out here. You see the dramatic swings. There's times when it's really high, there were times when it's really low, there's times when we're in recessions, when we're facing war, when we're facing pandemics, and all types of other major issues that you wouldn't expect and you don't plan on. But despite all of that, no matter what happens, JPMorgan has been a financial company that has been able to withstand all of these economic environments. They've been around for 1,000,000 years, and they're probably going to be around for another 1,000,000 years in the future. No matter what these interest rates, no matter what the economy, war, famine, or any other thing in between happens, JPMorgan is going to produce results. And you can see that from its long-term revenue, and then once again, like many of these companies, its long-term profitability. Now, this company is regulated by the United States government, and the reason why this makes the list is not because of its long-term revenue, not because of its profitability. The reason why this makes the list is because I want you to think of companies that would go bankrupt. There are many companies out there that you can think in a horrible time of the United States government falling down, which is one of the last companies that the U.S. would ever let go bankrupt. It's JPMorgan. Because if JPMorgan goes down, we likely all go down. This is one company that I could honestly never, ever seeing going bankrupt. If I had to pick one company that no matter what happens, as long as finance is still in existence, JP Morgan is still going to be around. And so that's why I highlight a chart like this with all of these negative things that have happened over the last several hundred years. JP Morgan is likely going to weather the storm and face its way through it and see brighter days into the future. Next up, and last but not least, we're going to zoom in on this because it's a little zoned out, and I just thought this was cool. You know, it's not super in depth about what Berkshire Hathaway does. It's more just so a broad overview, and the reason why it has to be a broad overview is because really Warren Buffett, and more importantly Berkshire Hathaway, is such a diversified company. It's so hard to find a business such as this because it's not really a stock. It's really a portfolio of products. You see that year over year, once again, as the story goes, growing revenue, growing profits, all that good stuff. But the reason why this makes the list, and is possibly the best one on here in terms of a defensive long-term compounder, is because it's almost like you're buying a small piece of the entire economy. For example, let's go back to Microsoft here. Microsoft was one that we talked about that I thought was really good, and we talked about Xbox Live, we talked about the company's suite of software that is really defensive and really a lot of businesses rely on and consider it a consumer staple, and it's almost like paying a utility bill. They're never going to cancel it. But really, when you look at Warren Buffett's portfolio, there's no way it could go down. And how do I know that? Because it's literally everything. This top circle is companies that they own outright, which includes Berkshire Hathaway Energy, which includes BNSF, which is a railroad company. It includes Fruit of the Loom, which is a clothing company. It includes Dairy Queen and Duracell and many other big brands like that. But it goes past just that. Their portfolio, where the companies that are public that they own a small percentage of, they own a huge $28 billion stake in Apple. They own Wells Fargo, a financials company, Kraft Heinz, a consumer beverage and food company. They own Bank of America, another financials, Coca-Cola, American Express, Moody's, US Bancorp, Phillips 66, Southwest, Delta, Goldman Sachs, Visa. There's all different types of companies that this company owns a position in, and they're one of the most heavily stacked financial companies on the entire market. Looking at this cash pile, cash versus debt is just ridiculous. If you look at their debt, they do have a lot on hand, sitting at $112 billion, but their cash is just as impressive. At $146 billion in cash, they're net positive, and let's actually go to the quarter so we can see the most recent update here. Even with the recent purchase, when this number's going down, they're still net positive in cash, and they still have $105 billion on the balance sheet. So Berkshire Hathaway is an easy one. This is almost like a layup. When you have a wide open break on a basketball court, it's a wide open layup, you're not going to miss it. This is one that I really think will do well, not only over the next 5 years, and not only over the next 10 years, I think it will do very well, as weird as it is for me to say, over the next 100 years. And so when I look at this, and I look at my different companies that I own, there are better opportunities for making big returns. There are more aggressive companies to invest in. But if you're looking for a defensive, safe investment that is almost like a guaranteed money to invest your money in over the next half decade, these are the 5 that I think you should be investing in because they're so diversified and they're such good companies to own. Now that is my list of the 5 stocks that I think are best for the next half decade, but let me know down below if you thought that this was good or bad list, and check out all the stuff down below in the description if you haven't already. And then get signed up with M1 Finance, which 127 people have done so far, and get $10 and help support the channel. But other than that, guys, thank you so much for watching, and I'll catch you guys next time.